Hello, folks. This is Brandon Chapman with TheoTrade. It's April 28th, 2025. And today's video is talking about the holding pattern that exists in the market. And I think about the term hold, and I think back to the movie Braveheart and Mel Gibson as he has the Scots lined up ready to take on the advance of the English. He's telling them to hold repeatedly, right? The idea is to continue to just wait, hold, as the English come bearing down on them with their horses, and eventually they kind of pull up these stakes and surprise the British and win the battle. But as we look at the market right now, we are in a holding pattern, right? We're just kind of edging higher the last couple of trading sessions with about 20 minutes left. We're sitting at the open and close, virtually identical in the S&P 500, a spinning top, a balanced day in the market. And the idea is, well, what should I do? Where should I go? Should I engage? These are all questions with which we have at this moment, right? But this is where, again, if we engage too aggressively, we may find ourselves on the wrong side of the market, having stepped out and tipped our hand to the market generally or to the English, and ultimately blowing it. That's what we're afraid of. And this is the deal: is that there's no one out here telling us, hey, this is when you need to engage. This is the direction you need to engage. This is a confidence game. You better have a strategy. And for right now, I don't think anybody really knows which direction the market's going to go. And how do we know that? Well, let's take a look at the VIX. Well, what do we see from the VIX? Well, number one, it's high. We've seen a rally in the market off the lows. Let's go back to the S&P SPX here. We've had a decent run off our lows down here at about 4,900, 4,850, and the VIX has mustered a decline over the last couple of weeks from about 60 down to 25. And, we saw a decent rally for a day or two last week. We didn't see profound drops like we've seen in the past in the VIX. These hedges are still intact. We look at SKU. SKU has run higher the last four trading sessions. We're now at 132, which is historically high. I'm looking for this to be back down here about 115 before I really look at this saying, hey, we've really reached that selling climax. It's time to really begin to commit to the upside. So the question becomes, if we sit back on our laurels, not really engaged in the market, are we eventually going to be prepared for what's going to stand before us? And Don's talked about this a little bit last week, and I did a whole session on this. The idea is, how do you engage in a market like this? And this is the great thing about options. Options provide limited risk, defined risk, right? Options provide an opportunity to kind of craft your trade, whether you want high probability, higher risk, low reward, or you want lower probability, higher reward, lower risk. You can construct it any way you want, and you can trade small. And as you're sharpening your weapons, ready to engage either bullishly or bearishly, you're able to trade in a climate that's relatively hostile and stay engaged with relatively little risk. You can do this easily through vertical spreads or other spread trading strategies that will allow you to kind of play both sides of the market. And by the way, you can do it at the same time. So for example, after this advance in the S&P 500, we're looking at today, we're in a holding pattern. What if we resolve ourselves to the downside, maybe only going to 5,100 again, maybe only going to 5,300? What if you decided to craft a spread trade at the current level that says, hey, if we pull back here to 54, 53, I'm out and I made money. And then as the market sells off and you're looking at it down here, 51, 5,200, you can go bullish again. And you can do this with limited risk, high reward if you want, and lower probabilities. Well, lower probabilities might mean what? Maybe a 60% probability, depending on how you set them up. In-out spreads might be closer to 70%. It's not exactly a low probability trade, but you structure it in a fashion that may provide higher or lower probabilities based on the profit targets you look at. And at TheoTrade, we have a very time-tested strategy in in-out spreads that you can plug and play. We have a class on, you can watch and get the rules. We'll even send you a strategy called an investing plan. They'll break down the strategy step by step. And each week, Don publishes his expected move, which right now is about $140. So if we look at where we currently stand after today's trading, if we bring up SPX, we're at about what? About $130 for this week. So if we move $130, Are you ready to go bearish? Or we move $130 lower? Are you ready to go bullish? The idea is there's ways to be able to do that without taking significant risk. There's a lot of people sitting in cash right now, waiting, wondering. The last thing you want to do is to wait to do something until we break 6,200 or to wait to do something before we break 4,800. There are trading opportunities right now that provide some of those possibilities. One of those setups today that's kind of interesting is in silver. This might be a silver lining possibly for some as the market tries to figure it out. Well, if we look at silver, I mean, silver's had a nice run here in the last couple of weeks. We're sitting just off our highs of 31.50. If we want to get an inkling as to what traders are thinking about SLV, maybe you don't personally have a lot of confidence. But I look over to the left over here and I see that gold outperformed energy and every other sector in the S&P 500 today. Well, does gold have a correlation with silver? Absolutely. In fact, we look at gold, which is up 1% today. We might be heading en route to maybe 318, maybe 330. But silver is a more cyclical metal than gold is. If the S&P is on good footing, or at least not extremely unsure footing like we saw back here, silver may have a chance of advancing to 31 or 32. But the great thing about the options market is that the options market, big trades exist, right? There's large trades based upon whatever they know or perceive about silver. And we can come down here to option time and sales. And I'm just going to leave this open. We'll just look at the call side here. And what do you notice? 40,000 contracts at 35, right? 39,998 contracts at 35 for August. Are they selling or buying the 42s? I'm assuming they're selling. These were spread trades, as it says off to the side over here. And we have scans that we can use to find this within ghost prints. But the idea is, what is this telling us? They're taking a stand today. They have held and they've held back. And again, today, they've made the decision that it's time to engage the enemy, those that might be short silver, okay? And what we see here for July, for example, 50,000 contracts traded, 80,000 contracts traded. Most of this traded in one print, buying the 35 and selling the 42s. Again, we come out here to August 15. Again, we have 40,000 contracts and 40,000 contracts, buying the 35 and selling the 42. Well, why would they sell the 42? Because these options are more expensive, right? They're buying 31% vol. They're selling 37% vol. These options are going for 18 cents. Why not reduce your cost substantially? But it gives us kind of a sense of where's 35. It's up here. By July, August, 42 is up here. Is it possible silver could get to 42? In this kind of environment, absolutely. We've been consolidating now for quite a while. We've had a nice run in silver. If the market finds its footing, silver might have a chance of leading gold. If the market doesn't crash and gold continues to rise, is silver about to be lifted up by its bootstraps to 35 or 42 in the coming months? So the question becomes, how long do you hold off making a decision to begin to trade and sit back in the village or wherever you're at saying, I'm not ready to engage the enemy? Meanwhile, the enemy may be bearing down. Or do you stand at the ready, look for small wins, small opportunities? Like, for example, in silver here, I'm going to throw out something you could consider or not, but in 20 June, for example, what could you look at here? Well, notice the volatility is rising as we move out of the money. I can buy low and sell high. I can construct a spread. Well, what if I were to buy the 31? I'll just go buy deep and wide. 1 month, 4-strike vertical. We'll go $2 wider. This is going for 55 cents. You risk $55 a contract in lieu of making what? $1.45 or $145? Maybe only shoot for getting maybe 70 or 80% on the 54 cents. In that case, you don't actually need the stock to get to 33. You just wait for it to get up here above 32 and you shut it down for a 70% return. Or you take 55, 54, 55 cents, times it by 1.7. Again, is that one way to play it? Sure. It's $55 of risk. So if you're sitting back 100% cash right now, or you're under 50% invested, you might take little swings so that you're sharp and you're ready to take action when you're ready to take action and not sit back waiting and miss what may be a pretty decent rally in silver or other parts of the market. Maybe the market's ready to sell off here. Who knows? Right? Very unpredictable. And that's why we're seeing the VIX stay high. That's why we're skewing skew remain elevated and continue to rise as they're hedging into the drop of the VIX, buying puts and selling calls, creating higher skew. The nice run here in the S&P may create another downside move. Friday, we looked at IWM and Ghost Prince as a potential opportunity to take a downside swing here. And again, playing both sides of the market, up and down, playing areas you think are bullish, areas you think are bearish. Doing it with limited risk may exactly be the formula that helps you maybe make a little bit of money, but at the same time keeps you prepared and ready. So when the real battle begins and you need to commit more of your capital, you're going to be primed, you're going to be prepared and ready to take action. Well, folks, that's the video for today. Catch you back next Monday. You have a great one. Thank you.